Welcome back to the channel. Today we're diving into 10 smart ways you can pay less in taxes using real estate. That's right, 10. Not one, not two, but 10 different ways you can optimize your investments and legally reduce your tax burden. By understanding and applying these strategies, you can enhance your investment returns and build wealth more efficiently. Let's get started. Let's kick things off with one of the most powerful tax advantages of real estate depreciation. Now, depreciation is a huge deal in the real estate world. The IRS lets you deduct a portion of your property's value each year for wear and tear. It's like getting a discount on something that's going up in value. For more information on depreciation, check out Landlord Studio. Now let's talk about 1031 exchanges, a powerful strategy for deferring capital gains taxes when you sell an investment property. Imagine this. You've held onto a rental property for a few years, it's appreciated significantly, and now you're ready to cash in. But wait. Before you do, remember those capital gains taxes? Yeah, those can take a big bite out of your profits. That's where 1031 exchanges come in. This IRS provision allows you to roll over the proceeds from the sale of your property into a similar like-kind property without triggering immediate capital gains taxes. It's like hitting the pause button on those taxes, allowing your investment to continue growing tax-deferred. Just make sure you follow the strict IRS guidelines and timelines for identifying and acquiring the replacement property. For a deeper dive into 1031 exchanges, head over to jmco.com. They've got some great resources available. One of the best things about real estate investing is the abundance of deductible expenses. I'm talking about those everyday costs of owning and operating a rental property that can actually lower your tax bill. Think about it. Property management fees, maintenance and repairs, insurance premiums, property taxes, utilities, and even advertising for new tenants. These are all legitimate business expenses that you can deduct from your rental income, reducing your taxable income. But here's the key. You need to be meticulous about tracking your expenses. I recommend using a dedicated software or spreadsheet to categorize and record every single expense related to your rental property. This not only ensures you're maximizing your deductions, but also makes tax time a whole lot easier. SmartAsset.com has a fantastic article on deductible expenses. Be sure to check it out for more details. Now let's talk about the mortgage interest deduction, a major tax advantage for real estate investors, especially in those crucial early years of ownership. Here's the deal. When you take out a mortgage to finance an investment property, the interest you pay on that loan is tax deductible. This deduction can be huge, especially in the early years of your mortgage when a significant portion of your payments goes towards interest. For example, let's say you have a $200,000 mortgage at a 5% interest rate. In the first year alone, you could deduct around $10,000 in mortgage interest from your taxable income. Now, as you make those mortgage payments over time, the amount of interest you pay gradually decreases while the principal portion increases. This means your mortgage interest deduction will decrease each year, but it still provides significant tax savings throughout the life of your loan. Now let's dive into a more advanced strategy that can be a game changer for serious real estate investors: achieving real estate professional status. This designation unlocks a whole new level of tax benefits, but it comes with specific requirements you need to meet. The main perk of being a real estate professional is the ability to deduct losses from rental activities against your other income without limitations. Typically, if you're a passive investor, you can only deduct losses up to a certain amount, and any excess losses get carried forward to future years. But with real estate professional status, those limitations disappear. To qualify, you generally need to spend more than 750 hours per year actively participating in real estate activities and more time on real estate than any other occupation. It's a significant commitment, but the tax advantages can be substantial. This strategy is best discussed with a qualified tax professional to determine if it's right for you. Now let's explore a unique investment strategy that combines tax benefits with community development investing in opportunity zones. Opportunity zones are economically distressed areas designated by the government to encourage investment and economic growth. By investing in these zones, you can access some pretty sweet tax incentives, including the deferral and potential exclusion of capital gains taxes. Here's how it works. You invest capital gains from the sale of an asset into a qualified opportunity fund, which is a fund specifically created to invest in opportunity zones. The longer you hold your investment in the QOF, the greater the potential tax benefits. It's important to note that opportunity zone investments carry inherent risks, just like any other investment. But by aligning your investment strategy with impactful community development, you can potentially reap both financial and social rewards. If you want to dive deeper into opportunity zones, check out Landlord Studio. They've got a great article on their website. Chapter 7. House hacking, live for less, invest for more. Now let's talk about a strategy that's perfect for both new and seasoned investors. House hacking. House hacking is a fantastic way to offset your living expenses while building equity and enjoying tax advantages. The basic concept is simple. You buy a multi-unit property and live in one unit while renting out the others. This strategy is especially popular with duplexes, triplexes, or even small apartment buildings. By living in one unit, you're technically considered an owner-occupant, which often comes with more favorable financing options and lower interest rates. And here's the best part. You can still take advantage of those sweet rental property tax deductions like depreciation, mortgage interest, and operating expenses, even though you're living in part of the property. House hacking can significantly reduce your housing costs, potentially even allowing you to live rent-free while your tenants essentially pay down your mortgage. The New York Post has a really informative article on house hacking. Be sure to check it out. Alright, let's get a little more technical and talk about cost segregation studies, a powerful strategy for maximizing depreciation deductions and boosting cash flow in the early years of ownership. Now, as we discussed earlier, depreciation allows you to deduct a portion of your property's value over time. But did you know that you can actually depreciate different components of your property at different rates? That's where cost segregation comes in. A cost segregation study involves hiring a qualified professional to identify and classify all the depreciable assets within your property, separating them from the building structure itself. By doing so, you can potentially depreciate certain components like appliances, fixtures, or even landscaping over a shorter period, leading to larger deductions up front. This strategy accelerates your depreciation deductions, reducing your taxable income in those crucial early years and freeing up more cash flow for reinvestment or other financial goals. It's a more advanced strategy, but for those with larger or more complex properties, it can be a game changer. Let's explore a powerful strategy for retirement savings. Self-directed IRAs for real estate investment. Unlike traditional IRAs, self-directed IRAs let you invest in real estate, offering more control and potential returns. Open a self-directed IRA with a custodian, contribute funds, and invest in rental properties or real estate partnerships. Rental income and profits grow tax-deferred or tax-free, depending on your IRA type. This strategy can diversify your portfolio and offer significant tax advantages. Now, let's wrap up by discussing the importance of incorporating real estate into your estate plan, ensuring a smooth transfer of wealth to your heirs, while minimizing potential tax burdens. Estate planning is essential for everyone, regardless of your net worth. By strategically incorporating real estate into your plan, you can potentially reduce estate taxes, avoid probate, and protect your assets for future generations. One popular strategy is gifting property interest to your heirs during your lifetime. This can help reduce the size of your taxable estate and potentially minimize gift taxes. Another approach is setting up a trust and transferring ownership of your real estate into that trust. Trusts offer several benefits, including asset protection, probate avoidance, and potentially reducing estate taxes. For in-depth information on estate planning strategies, check out the Tax Advisor. By implementing these strategies, you can significantly reduce your tax obligations and maximize the financial benefits of your real estate investments. Always consult with a tax professional to tailor these approaches to your specific situation and ensure compliance with current tax laws. Thanks for watching, and don't forget to like, subscribe, and hit the notification bell for more tips on building wealth through real estate.